Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. Number one, long-term market breadth continues to struggle. As a reminder, that's the amount of stocks that are participating in this long-term market uptrend that started back in March 2020 after the, of course, pandemic market bottom. Number two, the yield curve is starting to flatten as short-term rates are outpacing longer-term interest rates. And finally, all everybody's talking about is the supply chain shortages and, of course, the impact on inflation. Why some data in relation to inventories is starting to show that perhaps companies are starting to improve the amount of products that are on their shelves. So talking about market breadth, we look at a chart here, and the orange line is the S&P 500 price index, with the blue line showing the percentage of issues on the New York Stock Exchange that are above their 200-day moving average, a very popular measure of whether a stock's in an uptrend or a downtrend long term. And the real takeaway for this chart is the fact that this line, the percentage of stocks above their long-term moving average in a long-term uptrend, has been declining since November. Now, a lot of that story is related to the small cap area that has underperformed for quite some time, showed bouts of outperformance and underperformance here during the past few months, really showed life to start in the month of December, but has started to lag the past couple of days. So it's really been a mixed bag during the past several weeks, but the longer term trend is somewhat worrisome. If we continue to see this trend continue, the longer it does last, the more concerned this would be from a technical perspective. Now, obviously, Powell was just announced that he will be reappointed by President Biden next year. There's still some members to be appointed by Biden in the committee with the Federal Reserve. But if we look at interest rates in reaction to this, some interesting things here. The anticipation of rate hikes in summer to winter of December or 2022 has continued to increase, and we've seen short-term interest rates on the chart here. We have the 2-year and the 10-year in the blue. 2-year has started to jump up since the start of December. At the same time, long-term rates haven't done that at all. They've actually started to decline just a little bit. And when we look at the implications of this, it's the combination of those that leads to the spread, or the yield curve is starting to decline. So that yield curve is starting to flatten, where longer-term rates are not going up by as much as short-term rates. And what's that tell us? That tells us that perhaps, but it's still early, the market thinks maybe these rate hikes from continued inflation and an employment market that's strong, but still been struggling with that labor participation. Perhaps the market thinks these rate hikes might come a little sooner than the market can handle, but a lot that's going to happen between now and the summer of 2022 that could impact that rate decision. But right now, the market thinks maybe the Fed's going to hit the gas pedal a little too soon on interest rates, and we'll have to reverse course long-term due to the lackluster growth. In terms of the inventories, we talked about the supply chain and labor shortages impact on inflation. Of course, we just got the data out, again, very high during the month of November. Supply chains has been a big contributor to that. Not out of the woods yet. We're still seeing obviously backed up ports and things like that, but inventories starting to turn a little bit higher. Now, the optimist would say it's turning higher. The pessimist would say we need to see a lot more improvement from this. This is the inventory to sales ratio. And of course, it reached an extremely low level during 2021 as companies were not able to keep up with the record pace of demand and sales from consumers. But we started to see a lot of that savings spent down, and companies are starting to replenish their inventories. They've been really ratcheting up the pace at which they've been growing inventories, finally starting to catch up just a little bit with the number of sales. If we see a slowdown in those consumer sales because of sort of the spending and the fact that people are starting to get back to work, haven't got back to work, with that increase in inventories, perhaps we could see a little bit of a relief in the pressure on prices. And finally, I want to thank everyone for watching. We've got a nice picture here outside the port in California, a couple different ports throughout California. We've had backup in ships for quite some time. In late November, a line of more than 80 ships was cut in half, or most people thought it was, until they later discovered that, in fact, there were just some ships that had gone out from the bay away from sight. And when they were kind of counting those, they thought that they had seen an improvement in inventory. That wasn't quite the case, and they were just hiding. Actually, that number still sounds at 96. So this was one of those examples of where we thought there was a little glimmer of sort of that pace of ships being processed in the ports improving. Not quite there yet. The economy in terms of supply chain still has a lot of work to do. With that, I want to thank everyone for watching, and I'll see you next time.